This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
In this chapter, we return to look briefly at exchange rates and how they can give rise to certain types of risks for organizations. We look at a number of ways in which organizations can try to reduce those risks. And we also look very briefly indeed at what's known as interest rate risk. But first of all, exchange rates. And exchange rates are two main ways that countries have to try to organize exchange rates. The first is fixed. So the Bank of England might suddenly try to say that the relationship between UK pounds and US dollars is going to be 1.3, and that will never change. What that can mean, however, is if the pound appears to be weak, that the Bank of England might have to go out and spend an awful lot of its reserves, gold or dollars or euros, something of that sort, to buy up pounds to prop up the price of pounds so that its exchange rate of 1.3 is maintained. And if people really don't believe that the pound is worth $1.3, it's maybe only worth $1.2, then black markets can arise, so that people begin to exchange monies through other mechanisms. The alternative is a floating rate, which means that the relationship between two currencies changes really on a second-by-second basis, depending on speculation, depending on exchange, depending on inflation, depending on interest rates, depending on sentiment, how people feel a country is doing and how strong its currency is. So this fluctuates up and down, as I say, on a continuous basis. And it's in particular when you have a floating rate that you're going to have risk. Because if you sell goods abroad and you're going to get another currency coming in and the rate is changing, you're never quite sure how much that foreign currency is going to be translated to when it's paid into your bank account. And therefore it becomes difficult for you to budget and to plan if you don't know what the cash flows are going to be. Just a very brief mention here of something called a single currency zone. And the big single currency zone really is the euro. This was where a number of countries decided it's too much bother trying to change money between Deutschmarks and French francs and Italian lira and Spanish pesetas and so on. There's a lot of wasted effort and transaction costs. We'll do away with all our own currencies and we'll just have the euro. There have, of course, been some difficulties for some countries in dealing with the euro. One of the implications is that if everyone's dealing in euros, every country using the euro has to charge the same interest rates on loans. And some countries, if they have high inflation, ideally, the interest rates would go up. If they were in recession, ideally, interest rates would go down. But everyone in the Eurozone has to charge the same interest, so it makes some planning by the national governments rather more difficult. There are sometimes little variations of this fixed and floating here. Sometimes you can have a range, so instead of saying, well, let the pound float freely against the dollar, and instead of saying it'll be definitely worth 130, what the government might try to do is to say, well, I'm going to keep it between maybe 125 and 135. So it'll fluctuate between these levels, and if it begins to go outside these levels, then the government will take action to try to bring it back within those levels. Now, what sort of risks arise from floating exchange rates? Really, there are three types of risk. There's something called economic risk, which is to do with importing and exporting and how competitive these are going to be. It's to do with competition. There is translation risk, which is where you maybe have a foreign subsidiary. And if the foreign subsidiary, it keeps its financial statements in dollars, and the holding company has got its financial statements in pounds, then before you can join these sets of accounts together to get what's called the group accounts, you have to convert all of these dollar subsidiaries into the currency of the holding company. And depending what the dollar exchange rate is, these can kind of seem to expand and contract there. And finally, and the main one, is transaction risk. This is imports and exports. You agree to export something this month, maybe you don't get the money for 2 or 3 months, and the exchange rate has varied over 2 and 3 months. There's great uncertainty and risk in actually determining what money is going to be paid into your bank account. So let's look at the economic risk just a little bit more detail. If the pound gets stronger, so the pound will get stronger if instead of there being, let's say, $1.30 to the pound, there was $2 to the pound. The dollar's got weaker. For £1 I'm getting $2, whereas when the dollar was stronger, for £1 I get $1.3. So if I export something, which in my own currency was £100, when the dollar was relatively strong at 1.3, then the cost to my American consumer buyer would be $130. But if the dollar weakened to $2 to the pound, when I export this for £100, it's going to become $200 in America. And of course, the price seems to have risen from $130 to $200. The product is not nearly as competitive and maybe much more expensive, and has to compete with homegrown products who have not had to have this essential price increase. Note that you don't have to import or export to suffer this economic risk. If goods are being imported to this country, and because of the exchange rate movements, the goods coming in essentially look cheaper, the pound has got stronger. So goods are coming in costing $1,000, but now we're dividing that by 2 because there are $2 to the pound. That'll only be £500. So those goods get cheaper, which means that if I was a domestic producer of these goods, my foreign competitors' prices come down, and I may be suffering through the currency movement, even though I'm not importing or exporting. But the only thing you can do about this is to diversify where you are trying to sell. So not just selling to America, but sell to America where you're dependent on the dollar. You sell to Europe where it's going to be the euro. You're selling to countries in the Far East, selling to Japan where you're going to be looking at the yen. And you hope that not all the rates kind of change together, that if one rate goes up, the other rate goes down. And so if goods become more expensive in America, then maybe they become a little bit cheaper in Europe or in Japan. Translation risk, needn't worry too much about that, but there's no cash flow effect. It's not actually costing us anything. It's a kind of book entry, really. The subsidiary appears to get bigger or smaller, but it's really the result of arithmetic rather than any real cash flows. What people are suggested that you do, that is, if you are, let's say you have to buy assets in your foreign subsidiary for $1,000, then this is the asset. Then maybe what you do, instead of changing pounds to dollars and giving out your foreign subsidiary and letting them buy the asset in dollars, is you borrow. You borrow in dollars. And substantially the asset and the liability are going to cancel out. And your only exposure really is a net $100 kind of going up and down. But we needn't go, it's a little bit advanced. The one that people really kind of worry about is transaction risk, which is to do with individual purchase or sales transactions, importing or exporting, and you're not quite sure what money you're going to get for your exports or what money you'll have to pay for your imports. Many techniques are around to reduce the risk. Invoicing. You could say to your American customer, I will invoice you in pound sterling, your own currency. And of course, it doesn't matter what the exchange rate does. You are invoicing this person in £10,000. They must pay you £10,000, irrespective of what the exchange rate does. Essentially, this transfers the risk to your customer. And it's just a matter of negotiation. So you haggle about the price, you haggle about the quality, you haggle about who pays the transportation costs, and then finally you haggle in what currencies is going to be invoiced. Secondly, leading and lagging. So if you had to pay, let's say, at the minute, let's say you had to pay US dollars, so let's say times 2, let's say exchange rate is 2, and you knew you had to pay out $2,000 in a month's time, something of that sort, and you thought that the pound was going to weaken, so you thought it was going to be going down to let's say it's going to strengthen, let's say it's going to be going down to 1 here, then you would know, right, to get $2,000 today, I would pay $1,000. But if the pound really plummeted, so we had parity, we had $1 equal to £1, then of course what it's going to cost me in 2 months' time, and if this catastrophe happens, is going to be £2,000. And this is the game we all play when going on holidays. You begin looking at exchange rates. You think, should I change my money now, or should I wait and hope that the rate gets better? And if you say, gosh, I better change my money now, then that is known as leading. You accelerate the change and lock yourself into what you think is going to be a good rate. If you think the move is going to be the other way, then you would leave it to the last possible moment to change your money. Matching, if let's say on the 1st of January you're going to be receiving $5,000, and you know maybe on the 12th of January you have to pay out $4,900. So that's in, that's out. A sensible thing to do would be to open a dollar bank account, and when the money comes in, you keep that in dollars, and then 12 days later you can pay out $4,900. It doesn't matter at all what the exchange rate does. You're using dollars to pay dollars, and you've insulated yourself from the exchange rate risk. Forward contracts, we'll see in a moment. We didn't worry too much about interest rate hedging, and we really shouldn't be in there. That's another way of trying to deal with risk, which is really too advanced for this syllabus, and we'll look at futures and options in just a moment. But first of all, let's look at the forward contracts. These here are 3 methods where you are using a financial intermediary, normally a bank. The first 3 here are essentially internal. You don't really need any special arrangements with anyone. And a forward contract simply sets an exchange rate in advance. So a forward contract sets in advance the rate at which a particular sum of money can be changed at a particular date in the future. So you know that maybe you're going to be getting in, let's say, $10,000, or having to pay out $10,000, maybe in 3 months. We don't know what that's going to be quite in pounds because the exchange rate is going up and down. So you take out a forward contract, maybe at 125. So this means that your $10,000, so this here is the number of dollars per pound, £1 will give $125. This means that your $10,000, you can either change that to $10,000 or change the $10,000 back to pounds at a rate of 125. So this means you are definitely going to be getting £8,000 or having to pay £8,000. And it's a guaranteed rate. Okay, so this is guaranteed. And it doesn't matter what the real exchange rate does, you know what your cash flow is going to be in 3 months. The aim of forward contracts is not to get you the best rate, because of course the rate could move favorably to you there. If this was money coming in and the dollar strengthens, so it was $1 to £1, $10,000 would give you £10,000, you'd be kind of kicking yourself. But the purpose is not to give you the best rate or the most favourable rate. It is to say, for sure, in 3 months, I will have 8,000 to pay into my bank account. And that planning and that certainty is worth having. Forward contracts are binding. This means if this $10,000 for some reason doesn't appear in 3 months, the bank still requires you to pay them $10,000. And you might have to go out and change your currency into $10,000 and then change that $10,000 back immediately onto the forward contract. Futures contracts are a little bit more complicated. Basically, a futures contract is what's called a derivative. And derivatives take their value from something else, like an exchange rate or like the stock exchange index and so on. And if, let's say, the exchange rate moved from dollars per pound, let's say from 150 to 160, then basically the futures price will move like that as well. It tracks, it has got a price or a value which is determined by the exchange rate. Its value derives from the exchange rate. So what you can do is you can buy and sell futures to make a profit. So if you think the exchange rate is going to go from 1.5 to 1.6, you could go out and buy futures now at 150 and then sell them in whenever the maturity is, let's say 3 months at 160, and that will make you a little profit. And by clever buying and selling and doing it in the right direction, that little profit you make on the trading of the futures can be set up to compensate you for any loss you would make when actually changing the money. But I don't think we need to go any further than that. And finally, we have options. An option is the right but not an obligation to buy or sell a currency at a given rate in the future. It's different to a forward contract. A forward contract was binding. An option is a right but not an obligation. If you're selling currency, it's a call. If you're buying currency, it's a put. Okay, so if you're putting something up for sale, you're selling it. That's the way to remember it. And the great thing about options is you can either insist on exercising them, or you can allow them to lapse. Okay. So let's say what's going to happen is we're going to be receiving, let's say, dollars of 12,000 in 3 months. So it's going to be a receipt. And what we do is we take out an options contract to be able to change that, let's say, at 120. So this means if we exercise this option, 12,000, and that's dollars per pound, divide that by 120, well, obviously it's going to be £10,000, isn't it? So this would allow us to get £10,000. Now, let's take two situations. We don't know what the exchange rate is going to be in 3 months' time or 2 months' time, whatever the period of the option is. But let's say that the exchange rate was 150, or the exchange rate was moved to 110. So exchange rate, maybe currently 120, could either go up to 150 or down to 110. We don't know what that's going to be in the future. So what we could do in the future, we get $12,000 coming in. We could simply go out to the exchange market and say, I'll change it there at 150. So divide by 1.5. We'll be getting 8,000. Now, in that situation, the exchange rate has moved against us. The dollar is worth less than it had been. The dollar had been worth, £1 gives you $1.2. Now £1 gives you more dollars, $1.5. The dollar is worth less here. What you would do here is you would exercise your option. Say, look, I don't want 8,000. I will go and waive my option contract at the bank and say, I demand that you take my 12,000 and you give me, under this option contract, 10,000 in exchange. So you would exercise the option, make use of it. However, look what happens if the exchange rate had gone down from 120 to 110. So 12,000 divided by 1.1 is going to give you 10,909. So your choice is here, exercise the option and get 10,000, or let the option lapse, just ignore it, and go to the market on the day 3 months hence with your 12,000, and you get an extra £909. You get 10,909. So it's kind of heads I win, tails you lose. It guarantees you a minimum amount of money, but leaves open the opportunity that if things move favourably, you can make use of the favourable exchange rate. Because of that, because you are always kind of winning here, or always have the potential of winning, what you have to do is to pay upfront a premium, a non-refundable premium, to the person you're acquiring the option from. So maybe upfront you have to pay them to get this option, maybe you have to pay them £1,000, and that's gone forever, whether you exercise the option or let it lapse, because of the freedom really you've been given. It's like insuring yourself. You will never make less money than 10,000. That's your worst possible outcome, and it's like paying an insurance premium to guarantee you're not going to make a loss if you crash your car or your house burned down. So here's one for us to try. Here a French company is importing goods from the US at 200,000. The current exchange rate is euros per dollar, there at 0.75 here, and payment will have to be made in three months. And the company buys a 3-month option for 4,000 at what's called an exercise price of 77 euros per dollar there. So this here is going to generate them here. We're getting $200,000, and under this option contract, this is giving us 0.77 euros per dollar. So for sure, we will get at least 200,000 times 0.77, 154,000. That's our worst case scenario now. We can always exercise the option and do that. What's going to happen in here? Well, it's going to be 200,000 times 70, that would be 140,000. Or it is 200,000 times 80. Here we're getting more euros, if you like, per your dollar there, 160,000. So in this case here, you would exercise the option because 154,000 is better than 140,000. In this case, you let the option lapse. Because going to the market and changing 0.8 is going to beat that, and you ignore that arrangement you had. You are allowed to let it lapse. So options give great freedom, but you pay for them up front on this premium. So enough of exchange rates, let's look at interest rates, and interest rates can be fixed or floating. People will go for a fixed rate if they want certainty, but of course what they might be frightened of is we enter into a 5-year fixed rate, But what happens if rates go down? I'm going to be locked into paying 5%, when maybe I could be expecting to be paying 3%, because that's the way the market is run. So fixed rates will get rid of risk insofar as you know exactly what you're going to be paying for the next 3, 4, 5 years on your loan. But it means that if you've timed it incorrectly, you may be paying more interest than you really need to. Floating rate has got risk, because the amount of interest you pay could go up or could go down. And again, it means financial planning is very difficult. But people sometimes go for a floating rate because they think future interest rates will go down and they're willing to take that gamble. However, it introduces uncertainty, and there are a number of ways. I'm only kind of going to mention them here very, very briefly, because I think really quite at the edge of the syllabus, really. First of all, there is a forward rate agreement, and basically this is saying it's going to give you a kind of guaranteed interest rate. So you go to your bank and say, I'm going to be borrowing a certain amount of money in 3 months' time. I would like to fix now a forward rate agreement. I would like to fix now the rate of interest I'm going to be charged. And it's quite complicated, but it essentially means that you will be given a guaranteed rate to borrow or indeed to deposit money. Interest rate futures, these are again derivatives. And the derivatives, their value goes up and down according to the interest rate. So remember, derivatives, they take their value from something else. And here it is the interest rate. And again, what you can do is you can buy and sell the derivatives, these futures, so that you could make maybe a profit on the futures, which is maybe going to compensate you maybe for interest rates going up, if you're trying to borrow money. So it's a way of essentially getting back to a kind of guaranteed interest rate. And finally, we have interest rate options. And just like with currency options here, you could say, I have a right maybe to pay at 5% per annum. And you pay for that up front. You pay for this right. I'm going to be borrowing £1 million, and I want a right that the interest rate is going to be 5%. And if the interest rate, the actual interest rate, was say 7%, then you would exercise it. But if the actual interest rate was only 4%, then you'd let it lapse. Only a fool would insist on paying 5% if the actual interest rate were 4%. So there are ways here of insulating ourselves against variable interest rates going up and down. And again, the name of the game is to give certainty, not to guarantee you the best possible interest rate that you could ever expect to get.